The Russian government has recently intensified its economic conflict with Western nations by freezing the assets of major European Union banks operating within its borders. Despite heightened geopolitical tensions, these banks have continued their Russian operations, generating significant profits and paying nearly €800 million in taxes, inadvertently bolstering Russia's economy by facilitating transactions in Western currencies and partially evading international sanctions. One of the key sanctions imposed has been Russia's exclusion from the SWIFT payment system, which restricts its access to dollar and euro transactions. However, EU banks remain critical to enabling such transactions. Austria's Raiffeisen Bank International, RBI, for example, saw its Russian profits increase from under €600 million in 2021 to €1.8 billion in 2023, contributing €464 million in taxes to the Russian government. The Group of Seven, G7 nations, have pushed for Western banks to exit Russia. Yet President Vladimir Putin has thwarted these efforts by freezing banks' shares and banning the sale of their Russian operations, effectively seizing their assets. This has significant ramifications, leaving billions immobilized in Russia and crucial financial infrastructures available to Russian businesses. RBI manages accounts for 4 million individual clients and 2,600 corporate clients in Russia, offering access to SWIFT and Western currencies. Although Western countries imposed stringent sanctions in 2022 to cripple Russia's financial sector, Russia has established alternative trade routes, conducting much of its trade with China in renminbi and rubles. Russia remains a vital gas supplier to Europe, fulfilling 16% of its consumption by early 2024, which complicates efforts to sever financial ties. European industries depend on this affordable gas, and companies like Volkswagen face potential shutdowns due to energy shortages. Although the EU seeks to reduce dependency on Russian gas, it continues to import significant quantities through various channels, complicating the role of EU banks in Russia. These banks' continued operations are necessary for transactions involving Russian gas payments in euros. Shutting them down could force Europe to use rubles or renminbi, potentially increasing Russia's and China's geopolitical influence. Western companies have also accumulated substantial profits in Russia, with an estimated $8 billion at risk due to restricted access caused by sanctions. As of May 2023, over 2,000 foreign businesses remained active in Russia, despite many Western companies ceasing operations due to steep exit taxes and Kremlin pressure. Russia has countered with asset seizure threats, and legal battles highlight the complexity of international sanctions and property rights. Raiffeisen Bank is under pressure from both U.S. authorities and the European Central Bank, ECB, to reduce its Russian business. The bank's CEO mentioned that selling 60% of its Russian operations is likely, though retrieving funds may prove difficult. Meanwhile, the U.S. Treasury has warned that RBI's continued presence in Russia could limit its access to the U.S. financial system. Russia has signaled potential retaliatory asset seizures if G7 nations proceed with confiscating $300 billion in Russian central bank assets frozen by the West. The EU has started redirecting profits from these frozen assets to aid Ukraine, a move Moscow labels as illegal expropriation, while the G7 debates similar actions amidst concerns about the impact on future bilateral support for Ukraine. Russia's legal landscape is shifting towards authoritarianism, creating uncertainty about future foreign investment prospects. Experts believe substantial reforms will be needed for Russia to regain foreign investors' confidence after the conflict. On a broader scale, a trend toward de-dollarization is emerging globally as countries explore alternatives to the US dollar amidst growing geopolitical tensions. Russia and China are at the forefront, conducting over 90% of their bilateral trade in yuan and rubles as of April 2024. Even US allies, such as Brazil, are exploring similar agreements with China. Saudi Arabia has also discussed yuan-denominated oil sales with China, highlighting de-dollarization as a real and growing trend. These developments contribute to a gradual decline in the US dollar's share of global foreign exchange reserves, reshaping international economic dynamics and posing unique challenges and opportunities for countries navigating this shifting landscape. The recent moves by Russia to immobilize Western bank assets, along with a broader trend of de-dollarization, present several potential challenges for the United States and its economy. For decades, the US dollar has held the position of the world's primary reserve currency, giving the US a substantial advantage in global trade and economic influence. As more countries begin to bypass the dollar for international transactions, however, this role is increasingly being called into question, and the repercussions for the US could be significant. Firstly, the global shift away from the dollar, driven by Russia and China's preference for local currencies like the ruble and yuan in their bilateral trade, diminishes the demand for US dollars worldwide. When other countries use the dollar for trade, it allows the United States to borrow cheaply and exert economic influence on a global scale. The dollar's dominance has also helped the Federal Reserve exercise considerable control over global monetary policy. A reduced demand for dollars could weaken this influence, making it more challenging for the US to respond to international economic crises or exert financial pressure on other nations through sanctions. Furthermore, if the dollar continues to lose ground as the global reserve currency, the US may experience increased inflationary pressures. The dollar's reserve status has historically allowed the US to finance its debt at relatively low interest rates because other countries hold large reserves of dollars. A decline in this status could lead to higher borrowing costs for the US government, corporations, and consumers. This would potentially drive up the cost of imported goods, placing upward pressure on prices domestically and exacerbating inflation. With inflation already a concern in recent years, this shift could complicate efforts by the Federal Reserve to manage the economy and maintain price stability. The US dollar's declining dominance also means that the ability to impose sanctions could be weakened. Financial sanctions are one of the US government's most powerful tools for exerting geopolitical pressure, as seen with Russia's exclusion from the SWIFT payment network. However, as countries move towards alternative systems and rely less on dollar-denominated transactions, the reach of US sanctions diminishes. This makes it harder for the US to isolate targeted economies or individuals financially, potentially limiting the effectiveness of such measures in achieving foreign policy goals. Russia, for example, has been able to circumvent some of the economic impact of sanctions by conducting trade with China in non-dollar currencies, which also bolsters its relationship with China and further dilutes the dollar's influence. Additionally, the potential for dollar depreciation could affect US economic power on a global scale. As countries hold fewer dollars in their reserves, the dollar's value may weaken relative to other major currencies. This could make US exports more competitive abroad, but it would also raise the cost of imports, leading to more expensive goods for American consumers. Furthermore, a weaker dollar could lead foreign investors to seek other currencies for safe haven assets, making the US financial markets more susceptible to capital outflows and currency volatility. Finally, the geopolitical landscape is evolving in a way that poses long-term strategic risks for the US economy. Countries pursuing de-dollarization, including US allies such as Brazil and Saudi Arabia, signal a shift towards a more multipolar world where multiple currencies could play a significant role in global finance. As alliances shift and economic blocs solidify outside of US influence, the United States might find itself with fewer economic levers to pull when addressing global challenges, from climate change to international conflicts. This could fundamentally alter the US's standing on the world stage and require a strategic re-evaluation of its economic and foreign policies to maintain influence in a changing global order. In summary, the diminishing role of the US dollar on the world stage, fueled by Russia's actions and the broader trend of de-dollarization, has profound implications for the US economy. These changes could lead to higher inflation, reduced borrowing power, weaker sanctions, a more volatile financial market, and a less influential position in global affairs. This evolving scenario underscores the need for the US to adapt its economic policies to address the challenges posed by an increasingly decentralized and competitive global financial system.